All right, welcome everyone to Value Investing Live. I am pleased to welcome back our guest this week, Shree Viswanathan, the founder of SVN Capital. As always, and some of you are always beating me to the punch here, say hi over in that chat. Let us know where you are viewing from, and do please feel free to post those questions and the comments throughout the presentation. We will get to those once we get to the Q&A at the end of things here, but get them running over there so we can have them all ready to go for us. Without anything further from me, I'm going to go ahead and hand things over to Shree, and we can jump into his presentation today.
Thanks a lot, Graham. Thank you for inviting me back and giving me an opportunity to present today. It's truly an honor to be invited back to speak at Guru Focus, a platform where so many investment stalwarts have presented before. Sincerely appreciate it. Thanks again. Here's what I had in mind as agenda for today. I'll quickly run through a few slides upfront, reintroducing me and SVN Capital to your audience, and spend about 10 minutes or so revisiting the two names that I had presented last year, and then another 20, 25 minutes or so presenting a new idea. I'll try and leave plenty of time in the end for Q&A. With that, let's get started. Hello, everyone. I'm Shree Viswanathan, founder of SVN Capital. There's a hello from my compliance team. A little bit about me. I'm originally from India. I came here as a graduate student pursuing a master's in accounting, finished my MBA at Chicago, being associated with capital markets for well over 20 plus years now. When I launched SVN Capital, I strongly believe that turnover, transaction cost, and taxes are the true bane of investing. I still believe so. I've set up SVN Capital to address this. It's a concentrated portfolio, currently 11 stocks, globally diversified, with low turnover and, as a result, low transaction cost and taxes. A little bit about SVN Capital. The investment committee is here talking to you all. Alignment of interest is an important thread that runs through the fabric of SVN Capital. I look for management teams that are aligned with us as investors, with good ownership interest, aligned with various other constituents through a fair and equitable pay and incentive structure. I am aligned with my investors by having most of my liquid net worth invested in the same strategy. And in the fund, I'm even more aligned with an equitable fee structure with no management fee, only performance fee. The crux of today's presentation actually starts here. Before I invest capital into any new name, I look for affirmative answers on these 4 questions in that same order. First is the proverbial circle of competence question. I would like to remain within, and so I avoid a few sectors that I'm not comfortable in. Oil and gas, Bitcoin, biotech, or some of those, but many others are fair game. Number 2 is the quality of business viewed from a variety of different angles. Number 3 is the quality of management team. Skin in the game is important. Owner operated is something that I prefer. I look for capital management decisions. So quality of management team is the third important question. And then finally, ask if the opportunity is available at a reasonable valuation. The name I presented last year in this forum is Evolution AB. EVO, that is the ticker. It's a Stockholm, Sweden-based company that's a market leader in providing online live casino games to operators around the world. Think of traditional games like blackjack or roulette with a live dealer on your computer or your phone. It's a B2B provider with more than 500 customers, including some of the biggest names in the industry like DraftKings and William Hill and Entain. Evolution has its studios in Eastern Europe, Latvia and Georgia, pretty close to the hotbed these days, but not impacted by anything that's happened in Ukraine so far. Increasingly, they're having more studios opened up in North America as well. So global gambling is a large market with gross win expected to be about $475 billion by 2022. Much of that is from traditional brick and mortar casinos. Online gambling gross win is growing fast, but is less than still 20%. And within that, live casino, which is even smaller, but is the fastest growing segment. So Evo is essentially a monopoly in that market with well north of 50% market share. As you can see, the operating leverage is a fantastic number, with revenues over the last 10 years growing at 48% and operating income at 60%. The company was founded in 2006. The founders are still on the board, and they own a chunk of the equity. I believe for a strong company that has been growing at this rate, generating this kind of returns, it's trading at a very attractive valuation. So what's happened since I was here last? I would say there are three new developments. Number one, late November last year, an anonymous author published a 122-page slide deck with a short report on Evo, alleging that people from various different prohibited geographies, I'll come back to that in a second, can access Evo games, and that Evo is aware of such transgressions. He also went on to say that he had mailed a copy of this report to the New Jersey regulators, who are likely to view this negatively and, in fact, likely to punish the company or even cancel its licenses. Well, a 122-page slide deck with this kind of a statement, it definitely had the shock and awe effect. Over the next 10 days or so, the stock declined by about 40%. The management team was caught a little flat-footed as a Swedish company, not having been exposed to this rough and tumble US-style capitalism. They were a little slow in responding, and the response was not satisfactory, and the stock continued to decline until the last week or so of December, when CEO Martin Carlson sat down with a sell-side analyst who flushed out all the questions that many of the stockholders had. And the company had also announced a 200 million euro stock buyback program at that time, which they just completed a few days ago. The company is still in contact with the New Jersey regulators, and the dialogue is ongoing. At a future point in time when both sides are comfortable announcing, the company will announce something. But my point is, should there be more regulations in this front, I think Evo is the best positioned to benefit from it. So that's number one. Number two, one of their biggest competitors is a UK-based company called Playtech. Playtech is in the process of being acquired by another company called Aristocrat. So as you may expect, that sort of an acquisition program has a little bit of a distracting effect on its operations. That's number two. Number three, operationally, the company is performing at a high level. The primary business driver of this type of a business is the number of bets placed. As you can see, as of Q4 2021, more than 20 billion bets have been placed across the network, and that's been growing steadily. Financially, the company has been performing very well. Sorry, the page is a little busy, but I wanted to put some numbers in front of you and show you why I remain quite excited about this compelling opportunity. The company has been doubling in size every 2.5 years or so, much of it organically. But based on numbers released for Q4 2021, it looks like it actually doubled over the previous 18 months or so. So for example, free cash flow in 2019 is just slightly ahead of what the revenue of the business was in 2016. Similarly, free cash flow in 2020 is a little better than the revenue in 2018 and so on. So in conclusion, I would say the business is performing exceptionally well. It's an outstanding business with strong competitive advantage, high return on capital and high reinvestment rate. And I believe it's trading at a very attractive valuation. That's number one. The second name I presented last year was Copart. Copart is the largest salvage yard company in the United States. About 5 million units come up for auction every year in North America. It's a large marketplace where insurance companies and several buyers like dismantlers, rebuilders, exporters, and used car dealers come to meet and transact. All insurance companies, auto insurance companies in the United States have an agreement with either Copart or its primary competitor. It's a network-based model, platform or marketplace with high barriers to entry, and Copart in particular has been generating great returns. I expect them to continue to do so in the future. It's a duopoly where Copart is the biggest player. The other competitor is IAA. Since 1990, the management team, back in 1993 or so, they had decided that the strategy would be to own the land on which these salvage yards sit. Acquiring land continues to be the biggest CapEx item even today. It currently has about 250 yards in 11 countries. One of the important drivers in this business is the total loss ratio. Let me try and explain that real quick. So, insurance companies, auto insurance companies, typically have a view of what the pre-accident value of a vehicle is. So they will compare the pre-accident value of a vehicle to the total cost of repair after the vehicle gets into an accident or a claim comes through, and the value of the vehicle after the repair. Based on that, they will make a decision as to whether they should spend money on repair or total the vehicle. Increasingly, insurance companies are totaling the vehicles, primarily because of the increased complexity of the components that go into these vehicles, plus the added cost of labor as a result of consolidation in that in the repair shop network. While the total loss ratio declined a little bit in Q4, the long-term trend continues to be to move up and to the right. Here's again, look at the same sort of busy financial layout. Again, revenues have been compounding at a healthy rate. Operating income, this is a capital intensive business, is not quite as rich as it was in Evolution's case, but still a very healthy operating leverage. Free cash flow has been growing steady, and returns on invested capital is well north of 20%. Again, what has happened since I was here last, I would highlight one data point, and I think that's a significant positive. Just a few days ago, the primary competitor, IAA, announced its Q4 results. In the call, they said one of their biggest insurance clients is moving its business to its competitor. Neither IAA nor Copart would divulge who the client was. It is widely understood to be Geico. Geico leaving IAA to go to Copart. As one of the largest insurance companies in the country, I expect the increased volume from Geico in the future to be a significant positive. Other than that, the management team has been executing as expected. The beauty of 100% online auctions, which the company has been doing since 2003, combined with owning the real estate versus leasing the land, run by this high quality management team, has created significant value, and I expect them to continue to do so in the future. So those are my two picks from last year. The idea that I want to present today is a retailer, food retailer from Poland. The name is Dino Polska. Again, I've laid out the 4 questions from my investment criteria to flush out some of the highlights of this business. Dino Polska is the largest food retailer, fastest growing food retailer, I should say, not the largest, fastest growing food retailer in Poland. Has grown its store base at approximately a 30% compounded annual growth rate, and yet has only 6% market share. The size of this market is about 200 billion zloty. There are lots of big competitors. Jeronimo Martins is a company from Portugal, which owns a brand in Poland called Biedronka. There are competitors from Germany like Aldi and Lidl. But the primary focus of Dino is not these big cities, which is where these big competitors focus. Dino's focus is on small towns where its competition is mom and pop stores. Like Copart, Dino also owns the land on which these stores sit. Return on incremental capital is very healthy, and so is reinvestment rate. Company reinvests 100% of its cash back into growing its store base. Healthy operating leverage again. The founder is one Mr. Thomas Weisel. He's in his late 40s and owns about 50+% of the stock. I like these owner-operated businesses. And again, I think the stock is trading at a very attractive valuation. Before diving deeper into the actual opportunity itself, let me pause and take a slightly, a bigger picture view of why Poland, what Poland offers and why Poland. So since 1990, when Lech Walesa became the president, until COVID hit in 2020, Poland had not had a recession, had grown consistently at about a 4% rate. And in fact, it is the only EU country that did not go through a recession even during the 2008-9 global financial crisis. Here's a chart from World Bank which shows the GDP per capita. It's a very healthy $30,000 per capita, little lower than South Korea's, but much better than China's. Here's another slide, again from World Bank. It's a slightly denser slide than the previous one, but bear with me. The point is very important for Dino's strategy. Typically, when a country grows, particularly a country like Poland, which jumped from being a developing country into a developed country, typically you'd see the villages empty out into the cities, meaning the urban population will be much higher than non-urban or rural areas. That's what World Bank considers to be urbanization rate. United States, Western Europe are all in the high 70s, low 80% range. Poland, on the other hand, is less than 60%. In other words, there are more people continuing to live in these rural areas in Poland, and that actually plays very well into the strategy of Dino, which I mentioned is a strategy of focusing on these small towns. A page about the layout of Poland or layout of Dino Polska. It currently has about 1,800 stores, 400 square meters, which is about 4,300 square feet. They acquire the land. These are agricultural land from farmers, which they build with an internal team, vertically integrated in that regard, carry about 5,000 SKUs, competitively priced, competitive to particularly its mom and pop competition in these small towns. Poland has about 16 provinces. Here's a slide about how the company has grown its store base over a stretch of 10 plus years now. The map on the far left with one dot, that dot is a city called Krotoszyn. That's where the company is headquartered. Western part of Poland borders Germany and Czech Republic, which is actually a more prosperous part of the country. As you go east, the eastern part borders Lithuania and this current hotbed, Ukraine. That is a far less prosperous part of the country compared to the West. However, Dino Polska has been growing its store base from the West to the East, starting with about 110 stores in 2010. It currently has about 1,800 plus. Almost all of it has been organic. Here's another look at the same rapid network expansion. The map on the right with a few different colors highlights a very important point. The two provinces with dark green show the number of stores per 100,000 people. There are currently 12 Dino stores per 100,000 people in those stores, and it falls off rapidly across the rest of the provinces. As a country, there are only about 4 Dino stores per 100,000. Management team thinks that number can be improved meaningfully based on what they have done, which is on the left side of the slide. I believe they can accomplish that over a stretch of time. Even though Poland is a developed country, inflation is an important ingredient of the economy, and the inflationary impact is more like a developing markets inflation impact. According to the economists, they're currently about 9% inflation within the country. However, the like-for-like sales from Dino has been at a much healthier positive spread relative to food inflation. The green line on the left chart is the food inflation, and the red line is the like-for-like sales of Dino. I continue to expect them to put up that kind of a positive spread going forward. Again, a financial slide highlighting the strength of the operation. Operating leverage is healthy at 30% revenue growth and 41% operating income. Free cash flow has been growing at a steady high teens to low 20% range. For a food retailer to have gross margins in the mid 20% range is a very healthy metric. Overall, the important point here is the focus on reinvestment. As I mentioned earlier, the management team focuses on reinvesting 100% of its cash back into the store-based growth. It takes about 1.5 million zloty to open up a new store, and it takes about 3 years to break even. That brings up a very important point as it relates to this page. As you can see, it's a healthy, it's a highly profitable business, healthy margin generating business. But they've opened up a little north of 1,000 stores over the last 4 years. And those close to 1,000 stores are not contributing yet meaningfully to the bottom line. So as they mature over a stretch of time, the operating income and cash flow numbers are likely to go meaningfully higher. So even without that, they're continuing to remain profitable at this point. Back to the quality of the business, limited competition in the small towns of Poland. plenty of room for them to grow, continue to grow, long runway. They typically set up a store with a catchment area of 3,000 to 5,000 people. As the store starts attracting more people, they open up a store down the road. And so the competition is limited and the future growth is way ahead of them. Operating performance has been pretty strong over time, and I expect them to continue to do so in the future. Owner operated, as I mentioned, Thomas Weisel is less than 50 years old, and his capital management decision to reinvest in the stores has been perfect. They continue to put money not just into the stores, but also opening up more distribution centers. Another important feature of Dino Polska is that they offer fresh meat, which is not something that many of its competitors do. The company owns a meat processing plant and is in the process of opening up its second plant in the country. And Poles generally don't like to eat out. They like to cook at home, fresh food. And with that as the background, as I mentioned, they live in small quarters and the family size is large. And so it's not like a Costco can go set up operations in Poland and be profitable as they are in the United States. So Poles kind of access these Dino stores as frequently as we in the US access the refrigerator. The average basket size of a purchase is about 40 zlotys, which is about $10. And that leads to another important point, which is can e-retail be a threat to this business? Since the size of these basket purchases are small, I don't believe e-retail is going to be a threat, at least not in the immediate future. So those are the points I had for Dino Polska, and here's a slide deck about the valuation itself. The stock is currently trading at about a little north of 4% free cash flow yield, which I believe is attractive for a business growing at this pace with little to no debt. What are the risks? Competition is always a risk. And as I mentioned, the biggest competitor, the biggest retailer in the country is a company called Biedronka, owned by this Portuguese owner. They have thought about, they are working on opening up smaller stores in some of these smaller towns. But that reminds me of something like how United Airlines tried to open up a competitive brand called TED to go up against Southwest Airlines. They can try, but organizationally, it's not set up to service that kind of a client base. We're talking about small towns in Poland where Dino has had 20 plus years of lead in distribution, delivery, understanding the client base and things like that. So while Biedronka and a few others may be able to make some dent in a few places, I don't expect the competitive threat to be meaningful in the foreseeable future. For a company growing at this pace, execution is always a risk. I'll continue to keep an eye on that. So far, they've been able to prove us that execution is not a risk. And then finally, Thomas Weisel is only 47 years old, but he's the brains behind the operation. Should something happen to him, I would consider that to be a negative development against my thesis. So with that, I will pause and see if there are any questions. Grant.
Alrighty. Well, thank you for walking us through that, Shree. It does look like we have some questions lined up here. Jason beating everybody to the punch like usual here. Jason, apologies if I don't ask this exactly correct. It did get cut off when the page reloaded once we kicked things up. but I believe I got the gist of it here. First part of his question is looking at kind of investments in different areas around the world, as far as looking at domestic versus European versus emerging markets. Where do you stand there? Where's the money going? What are your thoughts on kind of each one of those different sectors there?
Yeah, that's a fair question. And I can answer that based on how my portfolio is structured today. A little less than 50% is in the United States. US will most likely continue to remain the biggest allocation from my standpoint. It's the biggest market, most transparent, really deep. However, over the last 18 months or so, I've had interesting opportunities pop up outside the US. An important side note I would make is, SVN Capital is a long-only strategy. I don't use any additional leverage. I don't hedge. I don't even hedge the FX risks from these non-US names. So that should answer some of the concerns regarding emerging market opportunities. While there are some fantastic countries and opportunities popping up, I always worry about the FX risk from some of these countries. I've spent time looking at an insurance company in Mexico, some interesting opportunities in Turkey, but these are countries that I know little about, and currencies that I'm not able to protect against. So as an emerging market opportunity, while there are many, I'm not necessarily invested there. Currently, the portfolio is a little less than 50% here. Sweden, Poland, Italy, and Israel are the primary exposure points at this time.
Gotcha. And then from there, and we hit on this a little bit there in your answer, but Jason was curious kind of on your thoughts on diversification versus concentration in any one of those specific ones. Obviously, sounds like the U.S. is relatively steady there. Are there any places, I guess, in these other countries that you're looking to maybe concentrate a little bit more of that capital in, or others that you might want to diversify into?
Yeah, my investment decisions are primarily, bottoms up driven, fundamental analysis based, bottoms up driven. Obviously, we've seen the U.S. market, correct a little bit over the last few weeks, and so a few more interesting opportunities have popped up recently. But the opportunity set, the portfolio as it exists today, I'm comfortable with. The opportunity set is dependent upon how various countries react to some of these recent developments and how much things correct. My bullpen list gets populated on a regular basis. I'm always revisiting that to see if there's anything that I would like to own. I haven't made any moves. I've started a new position in the US this year. That's the only name that I have added to the portfolio. And hence, it's actually 11 names today as opposed to 10 when I was here the last time. So it's a bottoms-up driven analysis. Only time will tell if anything new pops up from here on out.
Definitely. And final one here from Jason. He's curious, do you have any thoughts on Berkshire Hathaway's recent purchase of the old Bitcoin-friendly new bank? Do you think this might be a prelude to any direct investment there? Obviously, Buffett's been pretty adamant against it, Munger there alongside him, but it seems like things might be kind of changed and tied over there a bit.
Yeah, I have absolutely no opinion on it. I really liked the way Buffett and Munger have explained their position as it relates to Bitcoin. I'm assuming it's either Todd or Ted who has built up a position in this new name, but I don't have any opinion, and I don't have any exposure to that type of an asset class within SVN as well.
Fair enough there. And looking down on our list, looks like a question here from Dale, which I'll actually handle. He's asking about investing in Guru Focus. Dale, if you're looking for GFGF, head over to gurufocus.com. There's a link for all of that information there. If you are referencing any of the comments that Charlie made during our last member engagement meeting about a potential public debut of Guru Focus, you'll just have to hold tight there. I'd recommend joining us next week for our next member engagement meeting, asking Charlie himself there. Continuing on, though, to our questions for you here, Shree. Annie is jumping in, asking, looking at Dino there, what is the threat of war nearby doing to this company? What are we looking at in the future? Are the risks ramping up? Do we think something might happen here?
I think that's a fair question given the current situation in Ukraine. As I mentioned, the eastern part of the country borders Ukraine and Lithuania. Actually, northeastern part borders a small, slug of island that's actually Russia. Kaliningrad, I'm not sure if I'm pronouncing it right. So that's part of Russia. So you got 3 different countries on the eastern border. Ukrainians look up to Poland. Whenever you have 2 very differing types of economies, people from the poorer side of the country, of the border, would want to move up to the other side. And we see that here in the United States versus Mexico, see that across various other geographies. There are Ukrainians moving from Ukraine to Poland looking for a job, and it's been an ongoing trend. Will this newer development from Russia taking over those 2 provinces in the eastern part of Ukraine have any detrimental impact? At this point, I would say no. Poland has already taken in north of 1 million immigrants from Ukraine. This is over a stretch of time, not just over the last few days or weeks. This is over a stretch of time. They have taken on a little north of a million Ukrainians. Poland as a country is about the size of the state of California with 40 million people. But it's a lot more prosperous. As I mentioned, it's a developed country as opposed to Ukraine, which is a developing country. But as I showed you in the map, the Dino footprint is much denser on the western side of the country. And as we move east, it's a lot less populated. That is a positive, that is an opportunity for Dino. Some have said that may not be such a big opportunity because that region is less prosperous. It is less prosperous, I understand and I agree. But given Dino's profile, which is to cater to these smaller towns and villages as a proximity store, I believe even if Ukrainians kind of came over, it will actually become a lot more attractive from a Dino store offering perspective. So in the short to medium term, human mind will tend to kind of raise many of these questions. And it's a fair question. I've thought about it. In fact, the stock market has viewed it as such. And Dino stock is down, just about 20% or so year to date, particularly over the last few weeks. It's weaker, primarily because of that, as well as the inflation threat, I guess. But over time, I would think that wouldn't be an issue. Poland has a very colorful history. For about 50 years, it's been independent only for about 50 years over the last 500 or so years. And in between, it was actually wiped off the map. And it's, the people are fiercely independent. even when it was part of a Soviet satellite country, Soviet Union did not necessarily make it part of USSR, while the rest of the East European countries were. And they were always independent in that regard. They continue to remain so, and economically they are at a far different place compared to many of these other countries, including Russia. And so my view is this will continue to be a question in the minds of many investors, but over time we'll realize that it is actually a positive, not a negative.
Understood. And continuing down our list here, believe you hit on this right at the beginning, but Barry is curious, do you have any consideration looking towards oil and gas investments? I know the industry's kind of been shifting over there. Any thoughts on potentially getting involved if you aren't currently involved?
Yeah, as I mentioned, it's very important for me to sort of remain within my circle of competence. Early on in my career, I spent a lot of time in the financial services industry. I worked as a mergers and acquisitions a guy in a couple of different investment banks, and then did M&A for a bank, and worked as an analyst portfolio manager, focusing a little bit more time than others on financial services. That's a sector that I'm very comfortable with. I'm not invested in that space today. But oil and gas and financials are two sort of unique sectors in that the analysis needed for them are quite a bit different compared to the rest. The type of valuation metrics, the type of investors, they're all very different relative to the rest of the other sectors. Oil and gas is one that I did not spend any time early on, and it's a commodity product. At SVN Capital, what I have put together, I believe, is a collection of unique businesses with strong competitive advantage. These are businesses that are market leaders in the sphere of their operation. For whatever reason, the market has or had punished them in the past. That's when I found them to be attractive and added them to the portfolio. Oil and gas company, or many of these commodities, it is a commodity business, including many players within the financial services area. I find them to be highly competitive in a commodity business. That's not an area of interest for me. And as I mentioned early on top of it, it's a business that it's a sector that I did not spend any time on, and do not intend to spend any time on that sector going forward either. So I would avoid that for the foreseeable future. I'm always trying to expand my circle of competence, reading a lot about various different things, including Bitcoin, but I'm not competent enough at this point to really deploy my capital and my investors' capital into that space.
Fair enough. And on that note of expanding that knowledge base, Bobojan's asking, have you had the opportunity to take a peek at Africa? Any thoughts there? Any ideas? Have you looked at it or not looked at it, and why?
Yeah, I looked at least a couple of different opportunities in Africa, going back a couple of years. But bigger picture, that's not a geography that's of interest to me at this point. Most of these countries are in the emerging market bracket. As I mentioned, the FX risk associated because of the sovereign balance sheet or inflation or interest rate, puts me at a disadvantage relative to how I want to run SVN Capital. A couple of years ago, there's a company out of Canada called Fairfax. Fairfax has a few different fangs expanded into both India and Africa. So through that, I looked at one of their investments in Africa. Quite an interesting collection of businesses, but not interesting enough for me to actually deploy capital into it. These days, I believe for what I'm looking for, which are these dominant businesses with strong market share and competitive advantage. Many businesses available in the U.S., Europe, even Eastern Europe, like Poland. And I do own a business in Israel. So those are opportunities that are keeping me busy without necessarily going into Africa.
Gotcha. And Abel's got a good question here, asking you on the note of, these different investments in these different companies, like Dino, for example, that are worthwhile investments in your eyes. How are you coming about finding these ideas? Is it by word of mouth from other investors? Are you reading into the news? And I'll go ahead and expand this just kind of across the board. Where do these ideas come from? What does that funnel look like?
Yeah, that's a great question. I wish there was a sort of a crank that I can go to and sort of crank out ideas like that. But that's not how it works, right? It's both a collection of quantitative and qualitative search. Quantitatively, I run a number of different screens. I set up my own criteria for what I want to see as an output. And I actually have 23 screens. I don't run them all every week. There are 3 or 4 of them that I run every week, and I look for ideas from that. Qualitatively, I engage with a number of investors around the world. My network has actually expanded quite rapidly over the last 2 years or so. I'm always, for example, even though I'm not invested in Japan, it's a country that's of interest to me. It intrigues me a lot. However, for language reasons and other filing and governance issues, I'm not invested there. But I'm engaging with investors from Japan, many other countries. So qualitatively, I get ideas from reading stuff, engaging with other investors, reading their letters, and talking to management teams. Sometimes I get, for example, I spent a lot of time looking at this company, an insurance company in Mexico. I spent a lot of time with the management team. I still wanted to get, a very good idea about how the country operates, how the management team thinks about the opportunity set, who the other players are. And that question, who the other players are and what they do, that kind of takes me, it's like starting at one end of the thread and ending up at the other end. So searches like that. And eventually the idea is to let serendipity hit me. Reading and talking to and, running these things. I let them simmer in the back of my mind, and for whatever reason, something may perk up the order and come up to become a lot more interesting over time. So that's been my approach and continues to be so. In fact, the most recent idea that I've added to the portfolio is something that I looked at almost 2 years ago. For a few reasons, I had set it aside. And even though the stock price has inched up a little bit, moved up a bit, I still found it very interesting because of the overall development within the industry and how my own knowledge about the industry sort of evolved. So that's how I've been operating, and that's how I would like to continue to develop this portfolio.
Definitely. And it looks like Raphael's chiming in here. Looking back to Evolution Gaming, it sounds like they've seen share counts increasing, which has been diluting those shareholders. He's wondering, as a value investor, what are your thoughts there on some of these higher growth companies that have diluted shareholders over time?
I think that's a fantastic question. Let me address evolution first, and then the larger question about many of these tech companies that have been diluting. So evolution, yes, you're right. They did issue equity in 2020. In 2020, they actually acquired one of their biggest competitors at that point, a company called NetEnt. In fact, that's how I stumbled onto evolution. Going back to answering the previous listener's question, I was spending time looking at this company called NetEnt, another Swedish gaming company. And in June of that year, they announced that they were being acquired by this company called Evolution. So I ended up spending time on Evolution. That's how I got comfortable with it. So the primary acquisition currency in that transaction was stock. Since then, the company has made 2 other acquisitions, much smaller, and they've used stock in those transactions as well. I understand that it's partly because that's what the sellers wanted. Yes, it is. That kind of a dilution is a big negative. And I will actually take you one step further and give you a couple of other negatives from my standpoint as it relates to evolution. As a management team, one of the important areas that I look at in evaluating the management team is capital management decisions. Many European countries, in fact, it's a problem here in the US as well. Many European companies decide to pay 50% of their earnings as dividend. When you press them hard as to why they make that decision, it's primarily because that's what the shareholders want, or that's what the founders think the shareholders want. I think that's a very weak response. But in the case of evolution, in spite of that kind of a policy of paying 50% of their earnings as dividend, they have been reinvesting at a healthy rate. And so when you combine the fact that they issued stock to make acquisitions, and they make this dividend payment, it becomes a meaningful negative force. But since the company is so extremely profitable, for example, in the most recent quarter, EBITDA margin was 69%, and the guidance from the management team for the year 2022 is anywhere from 69 to 71%. So for every dollar of revenue, 71% becomes EBITDA, earnings before interest, taxes, depreciation, and amortization. I haven't seen many companies do that. So that sort of a healthy profit margin hides this negative development from dilution. They are aware of it. So this is a Swedish company with Swedish management team, previously it was owned primarily by Swedes and Europeans. Over the last 18-24 months, that ownership interest has transitioned quite meaningfully. They consider themselves to be an American-owned company. I've had a few different discussions with them. I intend to go there in June this year and meet the management team, and I've already given them a heads up that this will be an area of discussion. And they are aware of the fact that American shareholders prefer them to not issue equity, and that I'm assuming they will be mindful of that. So I expect them to not make that kind of share-based acquisition, stock-based acquisition in the future. Only time will tell. To your other point about tech companies issuing equity, yes, that's a significant negative. Even today, you still have many tech companies issuing stock-based compensation And so when you compute the free cash flow of these businesses, they actually add back the stock-based compensation, which is not something that I would agree with. And so the dilution impact from these businesses is quite significant, and many of them are unprofitable. For example, yesterday, a company called Sophie made a big acquisition in that space. Sophie is an online student loan and other loan-based products company, not profitable, but made a big acquisition, issuing stock. They've been issuing stock for its employees. That's a common thread across many of these tech businesses. Another item that I don't like, and it's not something that I would be interested in as far as SVN's portfolio is concerned.
Definitely. And looks like WK is chiming in here, asking, are there any fund letters that you regularly read that you'd recommend for our audience to go take a peek at?
Oh, yes. There are many. I'll at least list a few here. It's not a fund letter, but one of my friends, Chris Mayer, he runs a blog. He covers a number of different stock ideas, investment philosophies, books that he has read, stuff like that. He runs a fund called Woodlock House Capital. And if you Googled him, Chris Mayer, and associated his name with that fund, you'll come across that blog. As far as investor letters are concerned, there are many thoughtful writers that I follow. Chuck Akre. Those letters are not very long. Chuck Akre used to run Akre Funds. He has just now retired, but his handpicked successors write just as interesting as letters as he used to. Seth Klarman's letters, one of them just got released. It's difficult to get hold of his letters, but if you do get a chance to read some of his letters, they are very thoughtful, very, very long, 20, 30 pages long. Chris Bloomstrand out of St. Louis, he runs a fund called Semper Augustus. He writes one of the longest letters that I've ever seen, close to 100 plus pages, but they're very thoughtful, and particularly thoughtful about Berkshire Hathaway. So those are a few that come to mind. There are many, many other letters that I read on a regular basis, but slips my mind at this point.
Alrighty. Well, there you go, WK. A couple extra options there for you to go take a peek at. And currently, our last one in the list, I'm sure somebody will try and toss one more out now that I've said that, though. Dale is asking for your thoughts on Chinese listed stocks on the NASDAQ. What are your thoughts there on that market? Seemingly, they've been smashed down, offering up some unique opportunities. What are we looking at there?
Another interesting question, a market that I think will not just survive, but thrive over time. A large market, phenomenal businesses, fantastic management teams. But from my standpoint, there are a few important questions that I haven't been able to answer. And so I'm not invested there. One being governance. Many of these US listed Chinese stocks, they're actually not equities as you would think. Say if you own a JP Morgan or a Johnson & Johnson, they are pieces of the businesses here in the US. But in the case of, say, Alibaba or Tencent, you actually own a small interest in a variable interest entity in the Cayman Islands. So it's an indirect ownership interest. That's a governance question. Some are very comfortable owning that. I'm not. But beyond that, there are, in in any emerging or large and fast growing markets, you're going to have some fantastic management teams and not so fantastic management teams. To get a good handle on who to invest with and who to avoid, I think one needs to spend time on the ground, get to know the market inside out before deploying capital. I haven't been able to do that. In fact, just recently on that point, Charlie Munger conducted his annual Q&A session at Daily Journal. It was online. I didn't attend that live, but listened to it later. The first question that he got was on that very same point. It was Jeff Gundlach, a big fixed income manager, who had said that from his standpoint, China is not investable. And so this writer, this questioner, said, Charlie, Jeff Gundlach says China is not investable, but you have been a big fan and you have recently added more to your Alibaba exposure. Why are you, what gives you confidence? And Charlie's response is, yes, it's a fair question. I've been a fan of China. The country has grown at a rapid clip, has been successful in raising the largest number of millions of people from poverty into middle income and above category. Yes, I do own a variable interest entity. I'm fine with that governance risk. If somebody is not, that somebody should not invest in China. He said, I have similar compunction when it comes to Russia. And so I can understand Jeff Gundlach's reticence as it relates to China. So that's my view on China. It's a great market, phenomenal opportunity. I'm certainly missing out on a few names, but I'm not comfortable enough to risk my investors' capital.
Fair enough. Well, Shree, it looks like that is going to round out the questions that we do have lined up here today. Thank you so much for joining us, taking the time to answer these questions, and give such a great presentation. It's been an absolute pleasure.
Graham, thanks to you. Thanks to Guru Focus for inviting me back. I had a great time answering these questions, and good luck to you all.
For sure. And for anybody out there in the audience, if you missed anything, there will be a full recap here on YouTube and on Guru Focus. Like usual, please do take a moment to like the video, comment anything that you think we missed or we should cover in the future, and subscribe to the channel. It is one of the few things that you do get for free in this life. It is a pretty easy button to click there as well. Without anything further from me, though, I'm going to wish everybody out there in the audience and yourself as well, Shree, some strong returns here in 2022. Hopefully everything will pan out well for you.
Thanks a lot, everybody.